Advanced arbitrage techniques. Arbitrage trading, while inherently designed to exploit inefficiencies in financial markets, has become increasingly sophisticated with the evolution of technology and data analytics. Traditional arbitrage techniques, like buying an asset in one market and selling it in another for a profit, have given way to advanced strategies that involve mathematical models, statistical analysis, and complex algorithms. In this chapter, we will explore three prominent advanced arbitrage techniques: statistical arbitrage, pairs trading, and merger arbitrage. These strategies are used by hedge funds, institutional investors, and sophisticated traders to maximize profits while managing risk effectively. 1. Statistical arbitrage. Statistical arbitrage, or StatRB, is a quantitative trading strategy that focuses on exploiting pricing inefficiencies between securities through statistical models. Unlike traditional arbitrage, which relies on identifying obvious price differences, statistical arbitrage digs deeper into price movements, correlations, and reversion patterns, making use of historical data and algorithms to generate profitable trades. Principles of statistical arbitrage. The core of statistical arbitrage is based on the concept of mean reversion, which assumes that over time, asset prices will revert to their historical average or equilibrium. In this sense, statistical arbitrage seeks to identify when the price of an asset deviates from its mean, offering an opportunity to bet on its return to normalcy. Traders using this technique often rely on extensive historical data to model expected price movements and identify when an asset is over or underpriced. Two common models used in statistical arbitrage include mean reversion models. These are based on the idea that asset prices will eventually return to a historical average or equilibrium value. When an asset's price deviates from this average significantly, it is expected that the price will eventually move back to the mean, offering a profitable opportunity for traders. Cointegration models. Cointegration refers to a statistical relationship between two or more time series variables that, although they may fluctuate in the short term, maintain a long-term equilibrium relationship. For example, two stocks in the same sector might have a long-standing relationship where their prices move together. If one stock deviates significantly from this relationship, a trader could anticipate that it will revert to the expected pattern. How statistical arbitrage works. Executing a successful statistical arbitrage strategy involves several critical steps. These steps often rely heavily on data analysis, model building, and efficient trade execution. Data collection and modeling. Traders must first gather extensive historical data on a range of assets, stocks, currencies, bonds, or commodities. With this data, they build statistical models to analyze price movements and relationships between different assets. The goal is to identify assets that tend to move together, such as stocks in the same industry, and monitor for deviations from these relationships. Identifying anomalies. Once the model is built, it is used to track price movements in real time and identify anomalies. For example, if two stocks usually move together but suddenly diverge, this indicates a potential opportunity for statistical arbitrage. The model will help traders pinpoint when these anomalies arise and predict when prices will converge. Execution of trades. After identifying an opportunity, the next step is to execute the trade. The trader will take a long position in the undervalued asset and a short position in the overvalued asset, betting that prices will eventually converge. This involves buying the cheaper asset while simultaneously selling the overpriced asset, with the expectation that both will return to their historical relationship. Risk management. Like all arbitrage strategies, statistical arbitrage is not without risk. Model errors, sudden market shifts, or unexpected economic events can disrupt price patterns and lead to losses. Traders use stop-loss orders and constant monitoring to mitigate these risks. Diversifying across multiple pairs of assets can also reduce exposure to individual market movements. High-frequency statistical arbitrage. An extension of statistical arbitrage is high-frequency trading, HFT, where algorithms are used to execute a large number of trades at extremely high speeds. This requires significant technological infrastructure, such as low-latency connections to exchanges and advanced algorithms capable of processing vast amounts of data in milliseconds. High-frequency trading often focuses on arbitraging small spreads in highly liquid assets, such as major currency pairs or popular stocks. While the profit margins on individual trades are small, the high volume of trades can generate significant profits over time. Pairs trading is another form of statistical arbitrage that involves trading two related assets in opposite directions, one long, one short, based on their historical price relationship. It is a market-neutral strategy, meaning it aims to profit regardless of broader market movements by focusing on relative value discrepancies between the two assets. The fundamentals of pairs trading. The key idea behind pairs trading is that certain assets, especially stocks from the same sector or industry, tend to have correlated price movements. For example, companies like Coca-Cola and Pepsi, which are both in the beverage industry, typically have a strong correlation because they are affected by similar market conditions. When this correlation breaks down and one stock moves significantly more than the other, traders can take advantage of the price discrepancy by buying the underperforming stock and shorting the outperforming stock. Identifying correlated assets. The first step in pairs trading is identifying two or more assets that are historically correlated. Traders typically use statistical techniques such as correlation coefficients and cointegration tests to find pairs of assets that have a stable long-term relationship. Monitoring for divergence. Once a pair is identified, traders monitor their price movements closely. When one asset's price diverges from the other, this creates a trading opportunity. For example, if Coca-Cola's stock price falls sharply while Pepsi's remains stable, traders may buy Coca-Cola and short Pepsi, expecting the prices to converge. Closing the position. The trade is closed when the prices of the two assets converge. This typically involves selling the long position and covering the short position, locking in a profit from the convergence. Advantages of pairs trading. Pairs trading offers several advantages for arbitrage traders. First, it is market neutral, meaning that it is less susceptible to broader market risks. Whether the overall market goes up or down, the trader profits if the two assets' prices converge as expected. Additionally, pairs trading can be applied across various markets, including stocks, commodities, and even cryptocurrencies, making it a versatile strategy for arbitrageurs. Merger arbitrage. Merger arbitrage, also known as risk arbitrage, involves capitalizing on the price movements of stocks during mergers and acquisitions, M&A events. When a company announces its intent to acquire another company, the target company's stock usually rises toward the acquisition price, while the acquiring company's stock may experience slight declines. Merger arbitrage seeks to exploit these price movements. Understanding the merger process. In a typical M&A transaction, the acquiring company offers to purchase the target company's shares at a premium to the current market price. As soon as the deal is announced, the target company's stock price rises but often trades below the offer price due to uncertainties, such as regulatory approval, shareholder votes, or financing issues. Arbitrage traders attempt to profit from this gap between the current price and the offer price by buying the target's shares, betting that the deal will go through and the price will rise to the full offer. How to execute merger arbitrage track. Merger announcements. Traders closely monitor news of potential mergers and acquisitions. Once a deal is announced, they quickly analyze the terms of the transaction and evaluate the likelihood of the deal's completion. Buy the target company. The arbitrageur buys shares of the target company, anticipating that its stock price will rise as the deal moves closer to completion. The gap between the current stock price and the acquisition price represents the potential profit. Hedge with short positions. In some cases, traders may also take a short position in the acquiring company's stock. Since acquiring companies often see their stock price decline due to the costs associated with the acquisition, this short position can hedge against potential losses or amplify profits. Risk management. Merger arbitrage carries significant risk, particularly if the deal falls apart. Regulatory challenges, financing issues, or changes in market conditions can cause the merger to fail, leading to a sharp decline in the target company's stock. As a result, traders must conduct thorough research and continuously monitor the status of the deal to mitigate risks. Advanced arbitrage techniques, including statistical arbitrage, pairs trading, and merger arbitrage, offer sophisticated traders numerous ways to profit from price discrepancies in the financial markets. Each of these strategies involves a high level of mathematical modeling, data analysis, and risk management. While the potential for profit is significant, so are the risks, which means that traders must be diligent in their research and cautious in their execution. As markets and technologies continue to evolve, these techniques will likely play an increasingly important role in modern trading strategies.